Hi everybody, this is Phil Haloka from Complete Captive Management Services, and today we're going to talk about the elusive, sometimes elusive, captive underwriting profits. So let's address what they are and how they are in today's session. But first, let's identify Underwriting Profits 101. So when an insurance company issues a policy, the underwriting or the pricing of that policy represents the future cash inflows to the insurance company, aka revenue. So imagine this for a second is a commercial insurance company, and they issue policy number 1, policy number 2, 3, and 4, and so forth. The premium is the revenue into the insurance company, 100,000, 125, 150, and so forth. The SG&A represents the sales, general, and administrative costs, which is commonly referred to as the insurance policy expense load, which effectively means what's the cost to the insurance company to release that policy into the hands of the insured. So it's very common that an expense load for a commercial carrier is roughly 20%. Now that 20% can adjust sometimes based on premium size. So for example, this $100,000 premium, the expense load is 21%. This $75,000 premium is also an expense load of 21%, or 21,000, which represents a little bit more than 21%. So in total, let's assume that $450,000 of policy premium is collected from the insureds and all the policies that have been issued. $92,000 are the fixed costs, or the SG&A. And then let's look at losses. Losses can't really be predicted despite our best attempts to do so. So some policies are going to have no losses, and then some policies are going to be what we call losers. So let's assume that all of the losses total $270,000, which represents about 60%, which is a common footprint or an average of insurance company losses. And that represents, these three policies are profitable and this one is not profitable. So 450 minus 92 minus 270 yields $88,000 of underwriting profits based on a $450,000 income. Okay. A commercial carrier then is charged income tax based on the profits, which are 21%. So when you back out, you pay your income tax bill, you're left with $69,500. Okay? Now, let's assume that we're talking about a reinsurance captive, which is a group captive fronted by a commercial carrier. So we're going to take the $88,000 of underwriting profits, assuming we had similar performance, because if you're fronted, you're inheriting the SG&A expenses of that carrier. Okay? So $88,000 of profit. The captive manager is generally going to charge a percentage of the premium up to a certain point. And I would even suggest that there may be even a floor, because a captive management firm like mine, this is not very much revenue for the amount of work to issue these number of policies. So this may look closer to $50,000. The actuary and the auditor are service providers. And if you remember, I've mentioned to you that there's not very much delta in the pricing of these service providers because the workload doesn't differ whether you have 4 policies or 40. So they're many times going to say, here's my fixed cost to do your audit or to do your feasibility study. And these are probably pretty close representations of those costs. And then your captive is a domicile premium taxpayer, which is usually 0.4%. So when you take 0.4%, multiply it by 450, you get $1,800 of tax. That leaves you upside down if you're a group captive collecting $450,000 of premium. You're upside down 24 grand. Now, we haven't even talked about if the captive has a program manager, because many times people mix up a captive manager and a captive program manager. They are not always the same. So the captive program manager is not represented in this. Neither is travel and entertainment, legal, banking. And if you're a new captive, you may have a note from a lender to help capitalize your captive. None of these are in there. If these expenses were in there, this would be a greater negative number. Okay? So, where do you find these numbers? Well, the fronting carrier manages the bordereau report. So if you're looking to join a group captive, you need to look at the bordereau report, as well as to fully understand what these fixed expenses are, you need to look at the captive audit. So, negative 24,000 isn't good. So what is good? What's the minimum? What's the break even? You've heard me say this before, that if you're a captive promoter and you go to a fronting carrier, that fronting carrier is going to say, fantastic, Phil, let's form a captive together. Oh, by the way, you need to have at least X in premium after 12 months or a number of lives. Basically, that boils down to about $1 million of premium. You're going to need to collect $1 million of premium. You're going to have roughly $800,000 of claims and administrative overhead, which is expressed here. Okay? And then your service providers for your captive are going to be roughly $150,000, which leaves you profits of $50,000. And after Uncle Sam takes his cut, you're left with $39,000. Is that enough to share the wealth amongst the captive participants? It's not for me to say, but this is a very realistic illustration of if you're collecting $1 million, you should look forward to something about 50 grand of profit to distribute to the members, if you're distributing the underwriting profits to the members. So, I hope this was helpful. Next week, we're going to talk about underwriting profits, who gets them, and when do they get them. Have a good week. We'll talk to you then. Bye now.